Hey traders, welcome back. Today, we're going to dive deep into the MACD indicator, one of the most powerful and widely used tools in technical analysis. Whether you're a beginner or a seasoned trader, there are advanced techniques and nuances within the MACD that can drastically improve your trading decisions. I'll break it down step by step, from understanding how it works to implementing advanced trading strategies and making sure you're avoiding common mistakes. Make sure you stick around till the end, as I'll be covering real-world examples that highlight exactly how and when you can use MACD in different market conditions. Before we get started, don't forget to hit the like button, subscribe, and tap the bell icon for the latest trading strategies. Alright, let's get into it. Let's start with the basics of the MACD. The Moving Average Convergence Divergence is an oscillator that helps you gauge the momentum and direction of a trend. It's calculated by taking the difference between two exponential moving averages, EMAs, the 12-period EMA and the 26-period EMA. Here's why the EMA is used instead of the simple moving average, SMA. The EMA gives more weight to recent price action, making it more responsive to new price trends. In fast-moving markets like Forex or crypto, this is essential. The MACD is then accompanied by a signal line, which is the 9-period EMA of the MACD line itself. The intersection of these two lines generates the famous MACD crossover signals. Now, let's break down each of the key components of the MACD to ensure you understand how they work individually before putting them together. The MACD line. The MACD line is the difference between the 12-period EMA and the 26-period EMA. This line is at the core of the MACD indicator. A rising MACD line indicates that the 12-period EMA is moving faster and is above the 26-period EMA, showing bullish momentum. Conversely, a falling MACD line indicates a bearish market, as the 12-period EMA is below the 26-period EMA. The signal line. The signal line is a 9-period EMA of the MACD itself. It's used to smooth out the MACD line to reduce noise and help identify signals more clearly. When the MACD line crosses above the signal line, it's a bullish signal, a potential buy signal. When it crosses below the signal line, it's a bearish signal, a potential sell signal. The histogram. The histogram visually represents the difference between the MACD line and the signal line. The larger the bars, whether positive or negative, the stronger the momentum. When the bars are shrinking, it suggests the momentum is weakening, and a potential trend reversal could be imminent. Now, you might be wondering why the exponential moving average, EMA, is chosen for MACD rather than the simple moving average, SMA. To understand this, let's take a deeper dive into the technical differences. SMA, simple moving average. This indicator calculates the average price over a specific period, treating all data points equally. The result is a smoother curve, but one that lags behind current price action. The SMA doesn't capture recent price movements as accurately, which could be problematic in volatile markets. EMA, exponential moving average. The EMA assigns more weight to the most recent price points, making it more responsive and reactive to new price trends. This is critical in fast-moving markets like crypto, where price can move sharply in a short amount of time. One of the most commonly used signals from MACD is the crossover between the MACD line and the signal line. Let's take a deeper look at how to use this powerful tool. Bullish crossover, buy signal. A bullish crossover occurs when the MACD line crosses above the signal line. This is typically considered a buy signal. The logic is that the faster-moving 12-period EMA is gaining momentum over the slower 26-period EMA, suggesting that the price will likely continue to rise. Example: if you are trading EUR or USD, and you see a bullish MACD crossover when the price is near a support zone, it adds more confidence to your buy trade. Bearish crossover, sell signal. A bearish crossover occurs when the MACD line crosses below the signal line. This is seen as a sell signal. The idea is that the 12-period EMA is losing momentum, and the 26-period EMA is gaining ground, signaling a likely price drop. Example: Let's say you're in a long trade on GBP JPY, but the MACD shows a bearish crossover. This might be an early warning to exit your position before the trend reverses. One of the most powerful, yet often overlooked signals in MACD is divergence. Divergence happens when the price action and the MACD are moving in opposite directions. There are two types of divergence. Bullish divergence. Bullish divergence happens when the price forms lower lows, but the MACD forms higher lows. This is a strong signal that despite the market making lower lows, momentum is building on the upside. This can often signal that the downtrend is about to reverse. Example: on a BTC USD chart, if the price is making lower lows, while the MACD is making higher lows, it's likely that the downtrend is losing strength, and a potential reversal to the upside is imminent. Bearish divergence. Bearish divergence occurs when the price forms higher highs, but the MACD forms lower highs. This suggests that even though the price is moving higher, momentum is weakening, and a potential reversal to the downside could be on the horizon. Example: if AAPL is making higher highs, but the MACD is forming lower highs, this might indicate that the stock is losing momentum, and a sell signal could be approaching. So now, let's talk about the zero line. The zero line is a critical reference point that helps determine the overall trend of the market. Above zero, when the MACD is above the zero line, it means that the 12-period EMA is above the 26-period EMA. This typically indicates that the market is in a bullish phase, and traders often look for long positions in this scenario. Below zero. When the MACD is below the zero line, the 12-period EMA is below the 26-period EMA. This indicates that the market is in a bearish phase, and traders typically look for short positions or exit their long trades. Timeframes play a huge role in how you use MACD. The signals you get on the 5-minute chart are very different from the signals you get on the daily chart. Short timeframes, scalping and day trading. If you're using MACD for scalping or day trading, you'll likely focus on lower timeframes, like the 1-minute, 5-minute, or 15-minute charts. These charts will give you quick signals, but be careful of false breakouts since shorter timeframes are more prone to market noise. Medium timeframes, swing trading. On the 4-hour or daily charts, MACD can help you capture more sustainable trends and provide stronger signals. Swing traders typically use MACD in this way to identify entry and exit points within a broader trend. Long-term timeframes, position trading. For long-term traders, the weekly or monthly charts are used to capture macro trends. The MACD on these timeframes can help identify major shifts in market sentiment, but the signals may be slower to develop. Let's now explore some advanced strategies that incorporate MACD. 2 MACDs. Strategy. Some traders use 2 MACDs with SEC different settings, e.g. a 12-26-9 and a 5-35-5. This can give you a double confirmation of trend direction. If both MACDs show the same signal, it confirms a stronger buy or sell signal. MACD plus price. Action. Combining MACD signals with price action tools such as candlestick patterns, like doji, engulfing, etc., or support such resistance levels gives traders a much stronger edge. For example, a bullish MACD crossover near a support zone with a bullish engulfing candle can be a powerful signal for a buy. An often overlooked but incredibly valuable technique is using MACD in combination with volume. Indicators. Volume confirms the strength behind MACD signals. When you see a bullish MACD crossover and volume is increasing, that's a strong confirmation that momentum is real. On the other hand, a MACD crossover without increasing volume could mean the move is weak or short-lived. Tip. Use tools like on-balance volume, OBV, or volume oscillators along with MACD to validate breakout trades. Pairing the MACD with the Relative Strength Index, RSI, helps you filter out bad signals. Here's how to combine them. If the MACD gives a bullish crossover and the RSI is below 30, oversold, that's a stronger buy signal. If MACD gives a bearish crossover and RSI is above 70, overbought, it reinforces the sell setup. This combination helps reduce false positives, especially in ranging markets. MACD is powerful, but like any indicator, it's prone to false signals, especially in sideways or low-volume markets. Here's how to avoid common pitfalls. Always check market context. Is the market trending or ranging? Confirm with other. Tools use support, resistance, candlestick patterns, or additional indicators like RSI. Wait for confirmation. Don't act on the first crossover. Let the candle close and confirm the signal. Pro tip: avoid trading MACD signals during major news events. They often cause false crossovers due to volatility. Backtesting your MACD strategy is crucial to ensure it fits your trading style. Use platforms like TradingView, MetaTrader, or NinjaTrader to simulate trades. Test MACD on multiple assets, stocks, Forex, crypto, and across various timeframes. Look at win rate, risk-reward ratio, drawdowns, and consistency. Rule of thumb: if your MACD setup doesn't give you at least a 1.5.1 reward to risk, consider tweaking your entry, exit rules. MACD can be used across different asset classes, but the strategy should be slightly adapted. Stocks: watch for volume confirmation and earnings reports. Forex: MACD works great on 1H and 4H charts. Be mindful of news releases. Crypto: use higher time frames to reduce noise, e.g. 4H daily. Indices: look at MACD in tandem with economic calendar and sentiment analysis. Important: adjust your risk management depending on the asset's volatility. Some traders use simple moving averages like the 50 or 200 SMA alongside MACD to confirm long-term trends. For example, if MACD crosses above the signal line and price is above the 200 SMA, strong buy confirmation. If MACD crosses below the IHUR signal line and price is below the 200 SMA, strong sell confirmation. This method works well for trend-following systems, reducing the chance of whipsaws. Let's clarify a common confusion. Is MACD better for trend reversals or continuations? For reversals, look for MACD divergence plus candlestick reversal patterns. For continuations, look for MACD crossovers that occur after a retracement or pullback. Example, BTC. Pulls back to support, then MACD bullish crossover. Strong continuation setup. EUR-USD forms a higher high. MACD forms lower high. Possible bearish reversal. Here's a quick recap. MACD is best used to identify momentum and trend direction. Crossovers are powerful, but stronger with volume, RSI, or support genre resistance confirmation. Always consider the market context before placing trades. Practice in demo accounts and backtest strategies before going live. MACD can be a game changer when used correctly and consistently. If you made it this far, congratulations! You're now way ahead of most retail traders in your understanding of MACD. Drop your questions or chart setups in the comments. Let's analyze them together. Like this video if you found value. Subscribe for more deep dive trading content. Thanks for watching, and I'll see you in the next one. Stay sharp and trade smart.